50 billion euros in circulation. An unlicensed stablecoin operating globally, including EU markets, with no reserves that anyone had independently verified. MiCA Titles 3 and 4 exist specifically to prevent this scenario from happening inside the European Union. The Markets in Crypto Assets Regulations Stablecoin Regime. Titles 3 for Asset Reference Tokens and Title 4 for e-money tokens, is arguably the most consequential part of MiCA from a financial stability and AML perspective. And the Libra Diem proposals that triggered this legislation were the clearest warning signal regulators ever received. Here's what most people do not realize about stablecoin risk under MiCA. The reserve adequacy and custody requirements are designed around one specific failure mode, the reserve that is not really there. MiCA's ART and EMT rules exist because global stablecoin history is littered with reserve misrepresentation. For compliance professionals, risk officers, and treasury teams at any institution that holds, accepts, or processes stablecoins, the MiCA stablecoin rules define the entire risk perimeter. An unlicensed stablecoin is now an unauthorized product in EU markets, and a stablecoin run, a mass redemption event, is now a supervisory trigger under EBA oversight. Let me clarify the distinction because it matters enormously. An asset reference token, or ART, is a stablecoin that references multiple assets, a basket of currencies, commodities, or other crypto assets. Think of a coin pegged to a combination of dollars, euros, and gold. An e-money token, or EMT, references a single official currency, 1 euro equals 1 EMT. Both are stablecoins in common parlance, but they have different regulatory regimes under MiCA, different supervisors, and different reserve requirements. Under Title 3, ART issuers must obtain authorization, typically from their national competent authority, and meet ongoing requirements including maintaining a reserve of assets that cover at least the outstanding value of the ART, holding those reserves in segregated accounts with authorized credit institutions, implementing robust governance and risk management, providing unconditional redemption rights to holders at par, and publishing a white paper that discloses all reserve composition and risks. For treasury, risk, or compliance professionals at institutions that hold stablecoins, are you currently reviewing your stablecoin exposure against the MiCA ART and EMT framework? Are the stablecoins you hold issued by MiCA authorized entities? Drop your answer in the comments, because this is a due diligence question that many institutions have not yet fully worked through. E-money tokens under Title 4 are treated as close to traditional e-money as possible. An EMT issuer must be authorized as an electronic money institution under EMD3, or as a credit institution. This means the full regulatory perimeter of e-money regulation applies: capital requirements, safeguarding of client funds, redemption at par on demand, and oversight by the relevant NCA. The key addition for EMTs under MiCA is the white paper requirement and the specific crypto asset disclosure and reserve rules. MiCA creates a two-tier supervisory model for stablecoins. Tokens classified as significant, based on factors like number of token holders, transaction volume, market capitalization, interconnectedness with the financial system, and cross-border reach, face direct supervision by the EBA rather than their national NCA. Significant classification triggers additional capital requirements, liquidity management requirements, and interoperability requirements. A stablecoin that starts small and grows past the significance thresholds can be reclassified, and the issuer may face a supervisor with very different expectations. Let me run a scenario that illustrates the full risk picture. A global stablecoin, call it Global Stable, has 30 million EU holders and processes 2 billion euros equivalent in daily transactions within the EU. It claims to be backed one-to-one by US dollar reserves, but it is issued by an entity registered in a non-EU jurisdiction with no EU authorization. Under MiCA, this is illegal from 30 June 2024. Any EU-regulated CASP that continues to list or support Global Stable is facilitating trading in an unauthorized token. The AML risk of an unlicensed stablecoin, like Global Stable operating in the EU, is structural. Because it has no EU authorization, it has no legally required AML framework. Its KYC may be minimal or non-existent. Its transaction monitoring may be absent. Criminals can use high-volume unlicensed stablecoin flows as cover, hiding illicit transactions in the noise of billions of legitimate transfers. A licensed CASP that facilitates global stable transactions cannot verify what AML controls the issuer has applied to those tokens before they arrive on the CASP's platform. MiCA's reserve requirements for ARTs are specific about composition. Reserves must be invested in highly liquid assets with minimal market and credit risk, primarily bank deposits and high-quality short-term government bonds. The reserve must cover the full outstanding token value at all times. An ART issuer cannot invest reserves in high-yield or volatile assets, even if those assets might generate returns that the issuer wants. The mandate is stability and liquidity, not return. Independent custody by an authorized credit institution or investment firm adds a further layer of protection against reserve misappropriation. MiCA gives ART and EMT holders unconditional redemption rights at par and without excessive fees. This is non-negotiable. An ART issuer cannot refuse redemption, cannot apply haircuts to the redemption amount, and cannot impose material fees that effectively deny the economic value of redemption. This rule exists specifically because the Terra Luna collapse in 2022 showed how algorithmic stablecoins with notional backing could catastrophically fail to meet redemption obligations at scale. I want to hear from Treasury and compliance professionals at regulated institutions. Are you aware of any stablecoins your firm currently holds or processes that may not yet have MiCA authorization as an ART or EMT? What is your institution's plan for handling those exposures? Drop your situation in the comments. This is a live compliance risk management question right now. AMLA, the EU's new anti-money laundering authority, will directly supervise certain high-risk CASPs and significant stablecoin issuers. This direct supervision is a significant step beyond the ESMA and EBA coordination model. AMLA will be able to conduct investigations, request information, and impose measures directly on entities within its supervisory perimeter. For CASPs or stablecoin issuers identified as high risk, AMLA adds a layer of federal-style AML oversight above the national NCA. I have put together a comprehensive MiCA stablecoin compliance guide covering ART and EMT authorization requirements, reserve composition rules, redemption rights mechanics, and the AMLA supervision framework, all at davincidiligence.com. The full audio is available on the Da Vinci Diligence Spotify podcast. Links are in the description. The stablecoin regime under MiCA is built on one foundational principle. If a coin is going to be stable, it must actually have the assets to back that stability. Reserve requirements, independent custody, redemption rights, and EBA oversight are not bureaucratic burdens on innovation. They are the minimum architecture needed to prevent the kind of retail investor harm that stablecoin failures have caused repeatedly in the unregulated crypto space. Subscribe to catch the final episode of this series. Episode 8 is the enforcement episode. We look at MiCA's full sanctions regime, how license withdrawal actually works, what the early MiCA enforcement actions are telling us about NCA priorities, and what the ESMA register means for market transparency. That is episode 8, the one where all the theory becomes consequence. See you there.